Howdy there, folks. It's a buy one, get two free in this one. 3 videos up here for me to react to. First one up here, Fed rate cuts won't happen until the second half of 2024. Want to react to that one, share my opinions and perspectives on that one. Then we got this man from JP Morgan basically kind of predicting a little bit of a stock market crash here. I mean, this would be about 1,000 points lost in the S&P 500. The S&P could drop to 3,500 by mid-2024, he says. That's a significant drop. So I want to react to that one, kind of share my opinions and perspectives. And then since Wall Street's so addicted to talking about rate cuts in 2024, we'll react to this one from 5 hours ago. Rate cuts are unlikely to happen until the fourth quarter of 2024, says this individual out of Goldman Sachs. So appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed. New all-time high subscribers in the history of the channel. I appreciate each and every one of you. If you're looking to apply, join my private group, get access to all my different courses, access to the private Discord chat with the 6- and 7-figure members, access to see the moves I'm making in my nearly $2 million Fidelity account, all that good stuff. Check out the pinned comment. You can fill out an application, and we see if we can get you in there maybe a little later on this week. Alrighty, guys, let's get into this.
Our next guest says last week's eco data points to some further signs of a soft landing and says to believe the Fed's message that a rate cut will not come until the second half of 2024. What does that mean for a market that has been on a roll in the last few weeks? Joining us to discuss here at Post 9, BNY Mellon's head of U.S. Macro, Sonia Meskin. Sonia, welcome. It's good to have you. A lot of discussion about what Powell told us on Friday, particularly the line about being well into restrictive territory. Are we in a phase now where we kind of know what they think they want to do, but they can't afford to say it out loud?
Is she mimicking her?
It's possible, it's very possible. But what we really need to see, what we've seen so far, is that inflation has decelerated faster than we were afraid it would happen in 2022, right? So the sacrifice ratio, so-called sacrifice ratio, where unemployment needs to go up by a certain amount for inflation to come down, has been much smaller than was feared a year ago. And if this trend continues, the Fed may very well start cutting rates sooner, but it does need to continue, in fact, in 2024, and I think that that's an open question.
Do you expect it to continue?
We think that there may be certain factors that may be conducive to inflation decelerating this year that may stagnate or even reverse in 2024. So we may, in fact, hover above this 2% core PCE mark for quite some time in 2024. And that would, of course, induce the Fed, all else equal, to start cutting rates later rather than earlier in the year.
Morgan Stanley.
Yeah, so it cracks me up. It absolutely cracks me up that these folks think they can predict when the Fed's going to cut rates, okay? In order to get that timing right, let's be very clear, you need to time the economy getting hit substantially, because the Fed's not cutting until they really start to see some sort of real economic damage in the economy. And one of the big things you got to factor in is real wages getting a much better spot in 2024 and the potential strengthening of the consumer in 2024. And what does that mean for everything, right? The consumer's really been hammered for the last 2 years when it comes to real wages. Finally, we're going to have a good year in real wages, finally, in 2024. What does that mean? What does that mean for the economy? What does that mean for corporate earnings? What does that mean for the housing market, and even the auto market and things like that, right? Could we see a reacceleration as 2024 goes along, where the first quarter is the weakest, and then the second quarter gets better, and third quarter gets better, and the fourth quarter? You think the Fed's going to cut rates into a strengthening economy? That's a real potential. It's not a guarantee, but it's a real potential, and I just don't think anybody's even considering that. And the Fed's not just going to cut rates to cut rates. We know that. The Fed starts usually cutting rates when what happens? They start to see real economic damage.
Insinuating in a note that when the Fed does begin to cut rates in 2024, they're assuming that's a definite thing. It is still maintaining a certain level of restrictiveness, that it's not until 2025 when the Fed would move toward an easing cycle. Can you help explain kind of the difference between just cutting rates and then having a bona fide easing cycle? Because I think that helps inform our viewers and investors in terms of the difference here.
Yeah, of course. I think the difference really is in nominal versus real rates, right? And the real rate is nothing else but the rate of growth plus minus inflation. So when we look at inflation decelerating, that means that, and the Fed is maintaining a relatively high nominal rate, that means that the Fed is actually being restrictive. Now, the Fed doesn't know how sustainable this deceleration in inflation is, which is why they're coming out and saying we want to stay restrictive for longer, just to to be sure inflation doesn't reaccelerate, because we're still at a very low unemployment level, right? But it's tough to say into 2024 at which point they will decide, well, we're sufficiently restrictive, let's start cutting, and at what pace we should keep cutting.
Do we think that Waller's comments last week are consensus, that we can have this sort of benign series of rate cuts?
It's certainly the ideal, and it's certainly consistent with the notion of a soft landing, which I think the markets have priced in, and which I think as the chances, the objective probability of that has risen, given the developments in inflation and employment. But it's not a 100% guarantee. Right, there's still risks. The risks are on both sides, I think, of the distribution are a little fatter than normal.
If the market is prematurely excited about rate cuts, what does that risk look like at this point in time, as in terms of the way that the markets are currently pricing things in?
Well, I think you guys, you've mentioned that there's been some broadening out in market equity performance, and that's very, very encouraging. But really what we would like to see is not just the Magic 7 outperforming, but this spreading to smaller companies that are not necessarily very levered to AI specifically. And they've been more stung by higher rates, and especially as refinancings increase next year, it would be helpful for them if nominal rates decline, because they finance themselves in nominal terms, of course.
Yeah. Once again, man, I think it's really a dangerous game to play to assume you can predict when the Fed's going to cut rates. The truth is, no one has any clue. It could be back half 24, 25, first half 25, second half 25. It's just, I think after this year, I think everybody should be very humbled, right? Because everybody went in this year predicting recession. It didn't happen. The big one, oh man, unemployment's going to fly to the moon, all this stuff. We're screwed, never happened. And so I think after a year like that, everybody should be a little humbled, right? And kind of say, yeah, man, I think this whole macroeconomic stuff there's a reason why Warren Buffett says he puts no weight in economists in what they say in his investment decisions. There's a reason he says that, because no one can predict this stuff. And so, that's just it's a fool's game. And if you're making your investment decisions off of a fool's game of thinking when the Fed's going to cut rates and when the economy's going to be bad or good or those sorts of things, it's a fool's game, man. It's impossible to predict. It doesn't matter how tied in you are. I can't predict this stuff. I've been in this game 15 years. I pay attention to everything all the time, what everybody's saying, all the data. I tell you, I can't predict when exactly the Fed's going to cut or exactly when the unemployment rate's going to be this and this. It's just, you've got to factor in several different scenarios. And the problem with a lot of these folks is they only factor in one scenario. And they're like, this is when it's going to happen. And then they're wrong. They're like, this is when it's going to happen. This is when it's going to happen. And it's like, dude, in the stock market, there's a range of possibilities that can happen. No different than, I played poker for a few years, Texas Hold'em, and I thought I learned a lot of really valuable things that actually even taught me deeper lessons about the stock market. When you play a game of Texas Hold'em, a game of poker, there's a range of outcomes that can happen every single hand. And you have to take in these range of outcomes into your decision making in what you're going to do. Are you going to bet? Are you going to fold? Are you going to raise? You have to take all this into account. The same thing in the market. There's a range of outcomes that are going to come in 2024. And you have to kind of position appropriately based upon a range of outcomes. Not like, I think this one thing's going to happen. That's how you screw yourself, man. Because your one thing you think is going to happen is probably not going to happen. Next up here, the S&P 500 could drop to 3,500 by mid-2024. I mean, the truth is, it's no different than sitting at a poker table. The hand hasn't even been dealt yet. And you're like, I think that guy's going to get a flush over there, and this guy over here is going to get a straight, and this guy over here is going to have a pair, and I'm going to have, what are we talking about? No, you don't do that.
Market Technicals joining us is JP Morgan's head of technical strategy, Jason Hunter. And
he's a hunter.
You look around, and I wouldn't say you're particularly in love with what's happening right now.
That's right.
Are you, Jason? And it has to do with what I couldn't understand is you do think maybe we'll orchestrate a soft landing, but in doing so, we'll start perceiving the recession risk as much higher than we do right now, and that will hurt stock prices?
Yeah, wow. That's correct. Yes. Yeah, because when you look at the timing since curve inversion and go back into the 1960s and take yield curves that go back that far, as we move into next year, as that window continues to progress, you tend to find your way into a bear market that's eventually associated with a recession way more often than not. the odds are stacked in favor of a hard landing, actually. Our house view is that we actually land in soft landing. But when you look at how markets are priced right now, they're very much priced for a soft landing. Between here and there.
Wow. So he thinks a soft landing is coming, right? Which is, once again, another debatable thing if that actually is coming or not. But he thinks a soft landing is coming, and we're still going to 3,500. That's a big prediction. I mean, if you were thinking hard landing or even medium landing, I could understand 3,500, but wow.
We have the unfortunate experience that we're going to have to go to stall speed. That's what enables the Fed.
And let's be very clear. I mean, mid 2024 is 6 months away. 6 months. 1,000-point drop in SP 500 in 6 months, that would be heavy and painful. Whew.
To start easing in the second half of the year.
Great buying
and just that trajectory, the market's going to have a significant gut check of whether that inertia is going to carry to a recession or not.
It's pretty amazing because the market's so smart that you're forecasting maybe a slowdown on recession fears, but you're not forecasting a recession.
That's right. And then so there's always the uncertainty of whether that inertia carries as well. And the premium's just not in the market right now.
Good for bonds, though. Good for global bonds.
That's exactly right, yes. Yeah, the easy curve is yields lower, curve steeper in that year ahead outlook.
What's the Fed going to do in that environment? I mean, you're a technical analyst.
That's right, yeah.
So but what would, I mean, with that prediction, what do you think you would see end up with to give you that outcome? What would the Fed be doing?
Well, with the JP Morgan view, the house view that Mike Feroli and the U.S. economics team have, as we get into the back half of the year, even with the soft landing outcome, the inflation expectations and that softness in the data that takes you there allows the Fed to start easing at an every meeting pace as we move into the back half of the year. And that's, again, with a soft landing outcome, not even a hard landing outcome.
And you don't check with Jamie Dimon on that.
We talk within the research organization.
You talk within the research organization, because I'm not sure he would agree with that entirely. So there were a lot of really esoteric things in your note, too, about DM bonds. Is that developing market?
That developed market bonds, so the U.S., Europe, yes.
And those are expected to benefit even more than stocks, in your view?
Yeah, so stocks should pull back. In my base case view on the technical side, I think the S&P is going to drop to 3,500, which is just a retest of the low.
Oh, wait a second. Hold on a second. Well, I guess we buried the lead. Do you think? Just say that again, slowly.
So a retest of the lows for 3,500.
We're at 4,500.
Yes, 20% down from current levels.
Oh my God! And so that starts. So we get finished with the Santa Claus rally. Does this last a little longer?
Maybe a little bit longer, but it's already starting to decelerate to the point where our algorithmic-based signaling is already starting to show that you should be lightening up positions and starting to hedge at this point already.
I'll say, I'm running for the hills. We don't do anything. So 4,600. It's starting already, but in earnest begins at the beginning of next year.
So if you look at stall speed hitting as early as the second quarter and into the third quarter, the markets, given their typical leads and lag, should start to price that, the first quarter.
In January.
My base case view is 3,500 by mid-year, and then if the yield curve steepening as we expect, the market makes its bottom and starts to price in the next cyclical advance.
Towards the end?
Let's call it mid-year, yeah.
That's down somewhere around 3,500
where it makes it slow.
3,500 where no one's expecting that. That would play into the secular trading range.
That's right.
So in a minute, I'll tell you why I would absolutely love exactly what he said to play out there and why that would work perfect for me personally. But is it possible? Absolutely. It's possible, right? It's one of a range of outcomes. It's, I think you're going to have major worries about the economy. And not just major worries, but you would have to have proof, because everybody's been worried about the economy for the last several years. You're really going to have, you would have to have in that first quarter, second quarter, real concrete evidence of wow, the economy is really getting hammered and unemployment starting to go up substantially. Without the unemployment going up, you're just not going to get the market to really drop that significantly. We got the huge drop last year because you had a massive drop in earnings in 22. Companies were way overhired, right? On top of that, you had Fed raising rates. You don't have companies that are way overhired now at this point in time, and you don't have the Fed raising rates, right? So in order to get the market down substantially from here, you got to see unemployment tick up substantially, which is something we haven't seen.
3,500 to 4,800 range. That's right.
Yeah, that we're going to make and then when do we finally go to new highs. I mean, that's too far out for you, probably.
No, I mean, like if the curve's going to steepen and the Fed's going to be allowed to start easing in the second half of the year, we think about 2025 could actually be a positive year where you actually move on to new highs.
25 could be a positive year.
Yeah.
I think you mentioned in cyclicals, you've already seen them roll over.
Yeah, so if you look at cyclicals have been under pressure since 2022, and they never really rebounded this year, even though the broad market lifted quite a lot. It's a very thin leadership, where if you look at your cyclicals, not only in U.S. equity markets, but around the globe, commodity markets, emerging markets, specifically when you get closer to those that are linked to Chinese growth, have been under enormous pressure this year and have really failed to lift. That really adds conviction to our view that this is still a late cycle environment. It's only thin leadership that's what you tend to see in a late cycle environment. And until the cyclicals start to perform, which we don't think will unfold until, let's call it the second quarter of 2024, that's when you start to get excited.
So if I believed you, and if I was wealthy, and if I was allowed to trade, I would sell, if I believed you, I'd sell all my equities right now. And what would you tell me to do?
Right now, cash is paying about 5%. It gives you the option to
don't
wait.
Go out, but you like duration.
So you can go long duration. I mean, if you go long, a 5-year
give me a
point.
whole, okay, so I put some in the 2-year?
Yeah, 2 to 5 year point on the curve is where
2 to 5 year.
Yeah.
100% I'm putting in the 2 to 5 year. Governments?
Yes, governments, yes. And that gives you the optionality. You're picking up yields. You wait for the equity market to pull back to attractive levels, and then you roll from your fixed income.
Can I put it all into Bitcoin if I prefer?
That's not a market I cover. I cover a lot of markets.
I can't do that.
Yeah,
so
crypto is not one of them.
2 to 5 year, 100% of my cash.
Yeah, yes, that's where I would be right now.
God.
Wow.
You got it? Pressing me, Jason.
No,
we will, writing it, I won't forget. And you might be right.
Man said go all cash. That's a prediction to make. Okay, so I would, if you asked me, if I could choose, if I had a button to choose, would I want his scenario to play out or not? S&P 3,500 mid-year. And the answer is I would push the button that says, yes, I want that scenario to happen. Why? I'll explain why, okay? I have several hedges on for 2024. Almost all of them expire at the end of 2024 or the beginning of 2025, right? If we had a scenario where the market tanks in the first half of 2024, right? Those hedges are going to print money. Like they're going to be up hundreds of percent, if not much more than that, right? I can go ahead and get out of those hedges in probably the second quarter of the year, flip those into long positions, right? And go ahead and buy up stocks at just ridiculously attractive prices. Like obviously, there's already so many stocks at very attractive prices right now. You put the S&P at 3,500, that's a whole other level of attractive pricing. So I don't think it's the most realistic, but with that being said, I would love it. I would absolutely freaking love it, okay? Yeah, that's the advantage of having some hedges on. Because if you know how to do hedging properly, a little hedges go a long way if you have a major move down in the market. I mean, it's tremendous, okay? Alrighty, next one up here. Rate cuts are unlikely to happen until the fourth quarter of 2024. Goldman Sachs.
And themes are already beginning to take shape for the next year, for the new year, I should say. Joining us right now is Elizabeth Burton of Goldman Sachs Asset Management. And Elizabeth, we're looking at some moves this morning that are kind of crazy with things running up, people expecting rate cuts are going to come down. Do you buy it? And if so, if you think that's really the story, what do you tell people to do with their money?
Our position remains that rate cuts are unlikely to happen until the fourth quarter of next year. We think that the Fed has been on a pretty good trajectory and will stay where they are. But things can always happen and we can reevaluate. So I wouldn't be making market moves right now based on what's happening.
So do you think the runs that we've seen in places like the equity markets and gold and Bitcoin, are those overdone as a result? Because we keep saying those things are on the move because it looks like rate cuts.
Yeah, BTC's been rolling. And then gold, I believe, just hit an all-time high, which is crazy to think.
Coming sooner.
I don't know if they're overdone. What I would say is I think we're going to be in a range-bound area, at least for the next 12 months. I think there's a really tough case for further upside in equities, mostly because to have that happen at this point, we're going to have to see some margin expansion. And I don't know that we're really in that position just now.
So what do you tell people to do? Wait and buy wait for a dip and then buy?
So as a former allocator, I mostly focus on asset allocation as one of our big 5 themes for 2024. And there's a couple things I think are important. One, a lot of allocators are underweight to commodities. In fact, they took them out of their portfolios about a decade ago. I think commodities are going to be important. If you think inflation is going to be high and sticky for some time, I think that's going to be helpful. And there's some tailwinds behind the green energy transition for certain parts of the commodities complex. I also think with Sharpe ratios coming down, great, so we are expecting lower returns to equities across the board, but volatility is higher. So it used to be hard to allocate ex-US if you thought the Sharpe ratio was higher there, but when Sharpe...
So she's talking about lower returns for equities. Let's be very clear about this. This is a potential scenario for 2024, and I think it's a pretty realistic scenario. 2024 could be a year where the indexes don't necessarily get great gains, but you could have stocks inside the indexes that are climbing 50%, 100%, 200%, 40%, that are, let's call smaller companies in general, more small caps, mid caps. Those babies aren't moving the indexes. It's the Apples and the Microsofts and the Metas and the Amazons and all those stocks that move the indexes, right? So let's say those stocks have a little bit more of a chill year, and maybe, S&P only rolls up a few percent or something like that. You could still have incredible strength in the small cap space and the mid cap space. It's just not going to look like it because the market is so weighted heavy to these big companies, right? So that's just a little food for thought. I think that's a pretty actually realistic scenario and possibility for the market in 2024, and we're actually already starting to see it play out. Where a lot of the big dog companies have started to weaken here recently, but meanwhile, you look beneath the surface at some of these small caps, and you see stock after stock up 50%, 75%, 100%, 200% just in the past 3 to 6 months.
Across the board, and equities are 0.2 to 0.3. It makes it easier to make the case that you need geographic diversification. In addition to that, I think private markets are a good place to play when you're in this sort of range-bound area with low equity risk premium.
What kind of private markets?
I'm sorry?
Where in the private markets?
So we really like real estate credit. We like private credit. We continue to like parts of private equity as well. And I know that a lot of folks are scared of real estate. There's a lot of really unexciting and upsetting things that have happened over the last 24 months. But that should set the environment, both in the US and Europe, for some opportunities into next year. One thing that concerns me when I talk to allocators is that the themes that they're talking about in real estate. So I'm sure on this show you've heard a lot about people talking about life storage, or self-storage. Everybody's talking about it, right? So when everybody's talking about one part of the market, you want to be thinking about what the next part of the market. And European real estate can have very different behavior characteristics, especially in office, than the US market. So it's important to look not just in your home territory, particularly now when most US institutions, for example, have overweight biases to the US.
Have prices come down enough in the office market so that you think there are potential opportunities there or not? We had Mario Peoples on Friday last week, and he was saying, not yet, take it down. Don Peoples.
Don Peoples.
We have Angelica Peoples. We have a lot of Peoples around.
Seems to be the consensus. We just finished our European real estate conference, and the consensus is there's further to fall. I think it's very difficult to pick an entry point in any sort of market. So if you think something is good from a valuation perspective, it's always time to take a look.
I have a different question.
Sure.
So the base case that you have and the rest of the market has for the most part is that interest rates are going to come down.
Sure.
The Jamie Dimon case is that interest rates are not coming down. In fact, they might even go higher.
Right.
So if that happens, is there, to the extent you wanted to hedge for that, if you were going to, how would you do that?
Well, for one, I don't think it's wrong to assume that the upside risk remains in rates. If I was still managing a pension portfolio, which I used to do, I would be thinking about what if it is higher, what if it's going higher. That's a major risk to U.S. pension portfolios. Right. So look, rates are high. They're not the highest that anyone at this table has seen. When I was working in mortgages and, in 2004, they were higher than they are now. I grew up on a farm and we had like a 17% mortgage. So if a farm has it, people can pay these sorts of rates.
I could see her growing up on a farm. I could see that. And what she's bringing out here, by the way, this is actually a super important point what she's talking about, right? And, it depends on what age group you're watching this right now. If you're somebody in your 20s and watching this, or if you're somebody in your late 30s or 40s watching this, you might have a different view, right? But if you're younger, you think like, oh my gosh, this is insane. Like, we can't take these rates. And, throughout history, we've been able to take these rates for several years. So eventually it can cause a problem, but you can be at these rates for a while. And you can even have a healthy real estate market at actually these sorts of rates, right? There's an adjustment period where it's really rough, but then the adjustment happens. Sometimes it takes a couple of years, and then you're fine after that. And then eventually things come crashing down, right? But yeah, the rate picture, although it's insane based upon the past 15 years, if you go back 25 years, if you go back 20 years, if you go back 30, 40, 50 years, it's actually not crazy at all.
This isn't rocket science, but look for floating rates, look to real assets, look for diversification. The same playbook you did over the last 3 years probably won't work exactly as you think it will. We're not going back to 2019.
Also, as it relates to private markets, how do you feel about private equity now, given that I would assume at these kind of prices, there's not going to be that many great deals out there, unless you think that there's going to be all sorts of just messy things out there that'll be available?
It's a very hard argument to say you should stay out of private equity, right? You need vintage year diversification for that to happen. My bigger concern is that we'll see consolidation in the private equity industry. So the capital will be going
to the firms, the GPs.
Yeah.
Okay.
I think we'll be seeing larger deals, but I don't think it's time to get out of private equity. Maybe you become more selective, especially since a lot of institutional portfolios don't have a lot of liquidity. They can be more selective in this environment. But I remember when we had vol shocks in 2018 and people were asking, are people still trading vol? I mean, that's sort of a silly question. People don't stop trading markets because there's a hiccup, right? So I think you just get to be more selective in what types you're trading.
What causes that consolidation?
Wow, Alaskan Air down over almost 12% today. That's on that deal for Hawaiian Holdings, which is up like 200% today. Wow. So I guess their shareholder base do not like that move. Interesting.
In the private equity markets, look, I think this is a very hard time and environment for really small firms to try to raise capital when institutional investors are really liquid, the denominator effect, right? And also the back to work phenomenon. If you go to visit an allocator and they're only in the office 2 days a week, you better make sure you're visiting them on the Tuesday or Wednesdays in the office. So the face time is harder to get, right?
You worked at a pension fund in Hawaii. You've got a pretty diverse background.
I did. I worked at a Maryland pension fund as well.
Hawaii's better.
I'm not going to make a comment on which is better. Both have interesting.
I'll go out on
from a location.
I'll go out on a limb there.
It's led me to have a unique perspective on how the $5 trillion in pension fund assets in the U.S. move. And it may not seem like a lot of money, but if they move 1 or 2%, that can meaningfully affect things.
Yeah, 100%. Good point by her. So the moral of the story is, in regards to this whole Fed rate cuts thing, is do not make any investment decisions based upon when you think the Fed's going to cut rates or not cut rates, okay? And keep in mind, whenever they start to cut rates, it could be because things are going to get worse at that time over that next 6 to 24 months, okay? So don't even necessarily wish for rate cuts. If anything, I would wish there's not going to be rate cuts in 2024, because if there's not rate cuts in 2024, then that likely means the economy was good. The Fed's only usually going to start lowering rates when they really feel like the economy's starting to really, let's just call it get hit. And unemployment is starting to go up substantially. So just a little food for thought in regards to that. Appreciate y'all joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. If you're looking to apply to join my private group this week, check out the pinned comment, fill out an application. We see if we can get you in there a little later on. Much love and have a great day.